Hello, everybody. What's going on? This is Mark from Mediocre Money, and welcome to my personal finance show. This is the show where I dive into advice, strategies, research that help you become financially independent. So, today I'm going to go over a lifetime investing strategy. So, how you can invest your money over the course of your lifetime. This question came from Elizabeth, came a couple weeks ago, actually. So, it took me a little bit to get around to it, but it's a great question. And it's really wondering there is no shortage of investment advice out there. Most of it is horrible advice that is just trying to get you to pick some sort of stock and try to sell you stock picking advice. For the most part, this is self-destructive if you follow this sort of advice. So I had Elizabeth ask a question that said, "How do we invest over the course of your lifetime?" So that's what I'm going to be getting into in this video, and it comes down to quite a few different factors. But the very first thing that we need to talk about, though, when you're thinking about an investment strategy for your life, is what investment principles are you going to use? And I say principles, but this could be a plan, a strategy. I don't really care what you call it, but you need to have something. You need to know how you invest, and you need to have some sort of guidelines that keep you on the right track to achieve whatever financial goals that you have. So these are some of my investment principles that, for the most part, I don't come up with these myself. I take these from the world's best and brightest. I take these from Warren Buffett, from Charlie Munger, from Benjamin Graham, and I apply these to investing in the modern world. So my first investment principle is to buy and hold for the long term. Now, kind of a subset of this principle is to invest early and invest often. And the reason why we do this is for dollar cost averaging. And what that means is that, and by the way, my investment principles are regardless of where the markets go. They apply in down markets, they apply in up markets. It doesn't matter what is out of your control. So that's kind of the underlying theme of my investment principles. Well, I have two underlying themes. One is to which it's simple and actionable, because the more complicated it gets, the more work you have to do, the less you're going to succeed. That's just a fact. So if you can make simple, then you're going to make a lot of money. And that's been proven too. And Warren Buffett even recommends, he says the best investment strategy is the simplest. And the best, he means as far as portfolio returns. So the most profitable investment strategy is also the simplest then. So that's one of my founding principles, is to be simple. And then the other founding principle that I have is to be a passive investor that invests for the long term. And what that means is I'm not an active investor. I don't try to screw around with day trading. I don't try to move my money in and out constantly. This shouldn't be something that requires a lot of your work and time. And there's plenty of people in the world who are going to do this. My brother works in investing with RBC, and he's right in this world. And one of my best friends used to work in investing as well. They're right into this world. They are going to be on every single earnings call. They're going to be tracking global political trends, and they're going to be trying to move money constantly on a daily basis, maybe even hourly basis. All right. For 99% of us out there, this is horrible advice to be taking their advice, but also just to be thinking that this is what we need to do as a strategy. Warren Buffett has said that this is not a strategy for your average person. We shouldn't be trying to be these active day traders. So that's kind of the underlying themes of my investment strategy. So back to my principles, wanting to buy and hold for the long term. So you just constantly buy, and you just constantly hold whatever you have bought, and you just keep buying. And you invest early and you invest often. And that's going to get you dollar cost averaging. Dollar cost averaging is basically saying that, yes, you're going to buy stocks or investments or ETFs that are overpriced, but you're also going to be buying them when they're underpriced. And over the long term of you buying investments, the cost of you buying a certain fund is going to level out, basically. So you're going to buy them a little more expensive and buy them a little less expensive. But on the average, you're going to pay quite a lot less than if you're trying to time the market and buy when it's low and sell when it's high, etc. And another point around this is, are you investing enough? And I'll give you a hint. The average Canadian invests right now just a bit less than 3%. In the US, it is 2%. At the high end, over the last 20 years, Canadians have invested upwards of 6% of their income. And Americans, I think they maxed out at 4%. Is this enough? Do you think this is enough? How much money are you spending right now? That's probably going to be approximately how much you spend when you retire, if you ever can retire. I'm going to give you a hint. These numbers are not enough. At the rate that our economy has been rising as far as inflation goes, the cost of goods sold, I tracked house prices in the US and Canada over the past 20 years, the house prices have over 100 times themselves. They're insane. Not 100 times, sorry. They're over 100% more. So a house that cost $100,000 back in the early 2000s now costs well over $200,000. Over 100% growth. Do you think our incomes have kept up with that growth? I'll give you a hint. The answer is hell no. They have not kept up with that growth. So ultimately, because the cost of our goods and the cost of our lifestyle is rising much more dramatically than our incomes are rising, these numbers here are just not going to work for anyone who is really under 55. You need to save a lot more than this amount. For the most part, the answer to if you're saving more or if you're saving enough, the answer is no. You're not saving enough. You need to save a lot more and hence invest a lot more money. My second principle is to buy low-cost index funds or just low-cost ETFs, low-cost funds. And that is because Vanguard came out with some research that showed there were only a couple variables that actually affect how much money you make in the stock market or investing. And one of those variables is having a low management fee. Now, in Canada, the average management fee for mutual funds is about 2%. And that is insane, by the way. That is absolutely insane. Where Vanguard is kind of a robo-advisor, if you will. They're not actually robo-advisor, but Vanguard has their entire principle is to have as low management fees as possible. So the average Vanguard fund will run between 0.04%, yeah, that low, to all the way up to usually the higher ones I've seen are at 0.25%. Okay. These are, even at the higher end of things, at 0.25%, that is still exponentially lower than 2%. You are saving tons and tons of money. And to give you an example, I can't remember the exact numbers, but when I calculated out the difference between funds that performed exactly the same, the only difference was that you had a 2% management fee versus a 0.25% management fee. The difference was hundreds of thousands of dollars in management fees over the course of 15 years. So that's why we need to have low cost funds. It's extremely important. If you're paying over, my go-to amount is 0.5%. Anything over than that, I don't even bother. And anything under that, then it's all fair game. So that's kind of the rules that I go by, is to look for any funds that are under 0.5%. Warren Buffett recommends a low-cost index fund that tracks the S&P 500. So that would be something like VFV. I own a lot of VFV because of Warren Buffett's recommendations. I love it, and I'm going to buy more of it. So another one of my principles is to have a low turnover. This was another variable that came out of Vanguard's research. And what low turnover means is the more you buy and sell, the less money you have. Because with every transaction, you usually get charged a little bit. And that kind of rolls into my next principle, which is time in the market is more important than timing the market. Now, that's extremely, extremely powerful. There was some more research that found that if you missed the top 10 days of the stock market rising, that you lost about 50% of your portfolio returns. 50%. So, therefore, it's better for us to be just bought and invested in the market at all times instead of trying to sell our and take our money out and to buy back in when it's lower. At the time I'm recording this, we just had the COVID-19 crash, and then we had a big rally. And so we're up, I don't know, maybe 25, 30% since in the past month, even though it crashed like 35%. So that just goes to show you that, if we didn't sell, then your money would be nowhere nearly as lost as if you did sell. Mind you, I don't know what's going to happen in the future, but the point is still the same. We don't want to be buying and selling all the time. We want to buy, we want to hold, we want to be investing for the long term. So then another thing that we need to think of is diversification. That's one of my principles, is to always be diversified. Now, I think you should be, as far as your investments go, you should have other investments outside of the stock market. I'm a firm believer in that. I'm a firm believer that you should diversify your income streams. You should diversify your investments. So you shouldn't just be investing in diversified low-cost funds, but you should also be investing in maybe a local business, or maybe investing in yourself somehow. Or perhaps you buy some real estate. Real estate can be a very good investment to have as well. So that's another thing you need to think about too, is diversifying. Buying VFV, this tracks the S&P 500, the best 500 companies in the US. That's a pretty good diversified fund. And the funds that fall out of them, they stop buying them. So you stop owning them. So you only own the top 500. So that's pretty good. You can even diversify more than this too. So you can buy VFV, for example, is just the United States stock market, but you can buy index funds that track global stock markets, that track Canadian ones. Mind you, I think one of the biggest faults I see in Canadian investors is owning way too many Canadian funds. If you look at the Canadian stock market over time, it is just it's not very strong. I'm not saying it's a bad thing to be invested in your local country, but to be diversified means, you need to have a diverse fund, and Canada is not that diverse. Canada is very reliant on oil and natural resources and real estate, which are two places that can fluctuate quite rapidly. And it's just also not that diverse of an economy that we have either. The United States, the S&P 500 is probably the most diverse economy because that's where the entire world comes to list their stocks. So you can buy companies on the S&P 500 that are, yes, listed in the US, but they might operate globally. So you get a lot more diversification by investing outside of your just home country. And I highly recommend for Canadians to be invested in quite a lot into the United States stock market. So now we need to talk about downturns. So what do you do in a downturn? And this is what I do in a downturn. So I have something that's called asset allocation. So that's a question you need to ask yourself before we talk about downturns. And I'm going to get to how my life strategy, and I'm going to get to my investment strategy for over life, but I need to lay out these principles for you guys first, just so you understand where I'm coming from and how I invest for a lifetime strategy. So some questions you need to ask yourself first is, what's your asset allocation going to be? And asset allocation usually refers to the split that you have between income funds. So these are things like GICs and government bonds, and your equity, or your basically investing in the stock market, right? So what is your split between having just stocks? So like VFV would be 100% equities. It would be 100% invested in stocks. They don't own any GICs. They don't own any bonds. There is no fixed income available for VFV. It would be variable. So for myself personally, usually what happens is financial advisors, the recommendations range dramatically. Some people say you should invest a percentage based on your age. So if you are 30, you would have 30% in fixed income funds and 70% in equities. I don't think that's great advice. I think you can go a little bit more aggressive than that, but it depends on your tolerance for risk. So here's what I would do, or here's what I am doing. I'm about 30. I'm just going to be turning 30. So here's what I am doing right now. Currently, I'm investing in 100% equities, and I have been for all of my 20s. And the reason why I'm doing that is because I have a relatively long investment career ahead of me. And so I have the ability to take a lot of risk now because it's going to pay off a lot more in the future. So the equities that I'm invested in right now, I'm invested in VFV, and I'm invested in VGrow. I also have a couple other technology index funds in here. So VGrow is a split. It has 80% equities and it has 20% fixed income. And now that's on the more conservative side of things. VGrow is part of Vanguard's asset allocation funds, which means Vanguard has laid out a series of 5 funds for every single person's risk tolerance level. Okay, so right now my current split is, I would say, it's probably hovering around the 90% equities, 10% fixed income, just because I own VGrow. But as I get older, I'm going to change this. I'm going to start buying more conservative ones because they don't fluctuate as dramatically in downturns. So let's get into this. Let's get into downturns a little bit because we're in one right now. So it's great to talk about this. So I'm going to show you guys over here some of these asset allocation funds from Vanguard. So I pulled up VEQT. VEQT is 100% equities. So in the Vanguard world, it is, I'll X this out, VEQT, 100% equities. So in theory, VEQT is going to grow the fastest and the highest than any other asset allocation fund. So now let's compare VEQT to VGrow. Let's do that. So I pulled up VGrow right here. VGrow is in red. So as you can see, just before the market downturn, it looked like VEQT was slightly higher. And then we hit the market downturn. And as you can see, because of that, 20% diversified for VGrow in fixed income, VGrow hasn't experienced as much of a downturn. As a matter of fact, it's hovering about 3 to 6% higher than VEQT in this downturn. But let's expand this a little bit. Let's go over the last 5 years. So you can see before this downturn, look who's getting more growth. VEQT, the 100% equities. And so there's more risk. Yes, obviously you see this. VEQT has declined a little bit more than VGrow. But there's also more benefits to it as well, right? When it goes up higher. So that's kind of the difference between your asset allocation funds. And this gets even more dramatic when you compare it to funds with more fixed income. So let's take VBAL. So VBAL, VBAL. VBAL has 60% equities and 40% fixed income. And then there's even more conservative, and this one's called V Conservative Fund or something like that. VCNS. VCNS has 40% equities. So that's even lower. And then there's VCIP, which is 80% equities, 80% fixed income and 20% equities. VCIP that's the most conservative one. So if I was retired, I would try to have 100% VCIP just so I could have a steady income and also a steady rise in my portfolio. Although, to be honest, I'll probably have VCIP and maybe a little bit of VBAL something like that. But let's check out how VBAL compares to the 100% equities. VBAL. So here we go. You can see that VBAL has not declined nearly enough. Looks like it's about 7% there, about 7%. Yeah, about 7%. So it has declined not nearly enough, or not nearly as much as the 100% equity ones. But if we look over the past 5 years, you can see it also didn't experience the rises as high as the fixed equities did either. So that's the trade-up that you have when you're determining your asset class. So these are the asset classes that I recommend, going from VEQT, which is 100% equities, to VGROW, to VBAL, to VCNS, to VCIP at the most conservative level. So this is also correlates to your risk, basically, right? So the higher you go up this list, the more risk you have. So that is how your asset allocations are determined. So now I'm going to show you guys my entire lifetime investment strategy is to remain simple. Okay, so we got to keep that in mind. So because I want to remain simple, my strategy is going to seem pretty simple and easy to do. And there's a reason for that. It's effective. It checks off all of my investing principles, which almost guarantee me extremely good returns because I'm not buying and selling a lot. I'm buying low cost index funds. I'm getting dollar cost averaging from buying often and early, and I'm getting a very diversified funds. So it is really, really great for this purpose. So let's say that this is your lifespan here, your investing lifespan, okay? Or let's say this is the time when you have money to invest. So you might work later past this, but beyond this line, you're not investing any more money. So this is our lifespan here. This is what, approximately 20-ish when you start working. And this is, I'm not even gonna put an age here because this could be 30, this could be 99 for you. So the age of what you finish doesn't matter. But here's the investment strategy that I use. When you're young, you can go more risky, right? So I start off by buying some VFV, and then some VGROW. And I buy this stuff in my tax advantage accounts because, like my TFSA or a Roth IRA. And I buy it in my tax advantage accounts because those are going to give me significant returns because they are in 100% equities for the most part. It's a lot of equities and it's tax advantage too. So when I do pull that money out, they should have significant gains and I should be getting them taxed extremely low. So that's why you buy these funds early on in tax advantage accounts like your TFSA or your Roth IRA. Okay, so I start off by buying these and 100% into these. Now, mind you, this is after I have paid off all my bad debt, and this is after I have set up an emergency fund too. Those are just other principles of my personal finance strategy. So you start off by buying VFV and VGROW. And then maybe when you're hitting your late 20s or 30s, you say, you know what? I'm a little bit worried about market downturns and I want to keep a little bit more of my wealth. So I'm going to start to diversify myself a little bit more. So you're going to start buying something a little bit more with the fixed income. So maybe you buy VBAL. VBAL, remember, is 60% equities and 40% fixed income. So you start buying VBAL. And from this point, honestly, I would just keep buying VBAL. I wouldn't be selling anything here. So I would keep these VFV and VGROW and I would let those continue to grow. And I would just start changing what I'm buying. So I'm still sticking to my principles, which is buying and holding. I just change what I buy. So then I buy VBAL. And then maybe when you're around 40-ish, you're going even more conservative and you start buying something like VCNS. VCNS here. And perhaps you even want to buy some VCIP when you get into your 50s. Now, obviously, this process can be sped up a lot if you are retiring earlier. These ages that I'm listing out are just completely arbitrary ages. You can do this a lot you can retire a lot sooner, and this timeline would just speed up for you. Okay, I'm just putting these out in decades just as an example. But if you want to retire by the time you're 35 or 45, you would just condense this basically, right? It's all about your feeling. So if you feel like you've had some good growth from your VFV and VGROW, then maybe start buying some VBAL, maybe start buying some VCNS. And to be honest, even if you're 22, you can buy some VCNS if you're 22. And I'll tell you why in just a second. So this would be my investing strategy over my lifetime, is I just change what I buy as I get closer and closer to retirement. So over time, my portfolio starts going from, 90% equities and to, by the end of it, probably closer to about 60% equities. And then I'll just keep those in my retirement and just let that 60% equities, 40% fixed income pay the bills, basically. So that's the lifetime investment strategy. Now, there's a reason why you can buy VCNS, more conservative funds, or even VCIP when you're 22. Maybe you want less risk, and that's totally fine. If you want less risk, you can buy that. Or here's where it really comes into play some magic, is what happens in a downturn. So in a downturn, your VFV and your VGROW, they're going to decline significantly, right? So these two ones are going to go down in price a lot too. But your VCNS is going to stay relatively flat, maybe a little bit down, but not too bad. So what you can do here is, in a downturn, you actually have the ability to say, okay, now because these funds have declined so much, my initial split of whatever it was, 80-20, has now increased to 70-30. And maybe you want to have an 80-20 split still for your asset allocation. It doesn't matter what your split is, but here's the big magic, is that you can, in a downturn, sell your VCNS. Even though you've lost some money on it, you can sell it though anyways, because you haven't lost as much as you lost over here. And what you do is you then take the cash from here and you go and buy more VFV and VGROW. And so what that does is that brings your asset allocation back to what you're comfortable with. However, when the market kicks back up again, you get insane growth because you just bought a lot of equities. And then when the market kicks back up again, your investment income or your income from your salary, you can just keep buying more VCNS or maybe more VCIP. So that's how that works. That enables you to buy low and sell high and keep all of the sound investing principles. So that's my investing strategy for my lifetime. I know it looks a little bit complex here, perhaps, but all that I do is I buy VFV and VGROW. In a little bit, I'll start buying some only VBAL. And then later on, I'll buy VCNS and then maybe VCIP. And I just keep buying and holding. That's all that I do. And during downturns, you sell your more conservative funds and you buy the more riskier stock market funds like VFV and VGROW, maybe even VEQT if you want 100% equities. And then you get exponential returns from those market downturns. So that's not just a life investing strategy. That's also how you can extremely profit off of downturned economies. So I hope you guys enjoyed this video. Please subscribe to my YouTube channel if you like this video. It shows me that I'm doing some good videos for you guys, and it helps me get encouragement to keep producing more videos on personal finance. If you have a question that you'd like answered on personal finance, then let me know in the comments of this video. I'm happy to answer them, and I will see everyone in the next video. Peace out.